Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you who are joining me here on the East Coast. We also want to say good morning to those of you who are joining us from the Central Time Zones, the Mountain Time Zones, and Pacific Time Zones. And of course, we want to say good evening if any of you are joining us from across the pond in parts of UK or parts of Europe, and good early morning if you're joining us from parts of Asia or parts of Australia. Welcome to today's radioactive trading presentation. You may have been coming to Kurt's weekly presentations over the past few weeks, where you've seen discussion on the initial setup of a radioactive trade, and then you've seen some different applications of the various income methods that you can use to bulletproof your radioactive trade, generate income, and of course reduce the initial at risk. Well, today we're going to do something a little bit different. We're going to evaluate the initial radioactive trading setup. We're going to use the Trade Simulator tool over at Radioactive Trading. It's a free resource. You can access it any time. We're kind of going to illustrate why you might not be getting ahead the way you thought you were with your current option strategies, and of course why we feel the radioactive trading setup is a solution to your current investing problems you may be experiencing. Now we're going to discuss the comparisons of the trade entry, the different ways that investors ask about why would I open this position as you guys outlined in your radioactive trades, why wouldn't I do it this way, could I do it better just with a different setup as well. We're going to look at those common questions and give you our thoughts on why we don't particularly open a radioactive trade in that fashion. Then we're going to link over to the PowerOptions suite of tools. We're going to look at opening a new position, and then what we're going to do is track that position in the portfolio tools over the next few weeks, along with the comparisons we discussed today as well. And then, of course, we'll handle a few roundup questions also. So I hope you're all ready for some education here, and let's go ahead and get started. Now, for those of you that may be new to the concept of radioactive trading, radioactive trading techniques were developed by Kurt Frankenberg about 12 years ago. He had taken a course on how to trade covered calls and spread positions, and after he started it out in the first 2 or 3 months of trading and following his quote-unquote guru's advice, he ended up losing all of the money he had set aside to trading and got wiped out by a few bad covered call trades that just went against him, blew through the stop order, and of course he made a couple mistakes along the lines as well. But he didn't give up with his options investing after those losses. He realized that the money just didn't disappear. It had to go somewhere. So instead of looking at the main focus of the guru's advice and all of the seminars that are being taught, for $3,000 over a weekend to learn how to trade a certain strategy, he decided to develop a technique where he would focus on limiting his losses first, and then evaluate how to generate income and potentially cancel that original risk. And that's how the radioactive trading techniques were formed. Now, over the last decade or so, we've developed and further enhanced the radioactive trading techniques. There are now 12 different income methods that we use against the initial radioactive setup to further lower our risk, generate income, and potentially bulletproof the trade, as well as increase profits. And the main focus of the initial radioactive trading setup is to cut the losers short and to allow the winners to run. Things that we can't usually see with the credit spreads, covered call techniques, and naked put techniques, which generate income up front, but they cap your potential gain on the position, and you still may be forced to manage that position long term if an unexpected loss is incurred. Now, for those of you who don't know me, my name is Mike Chupka. I'm the Director of Education over here at PowerOptions. Of course, PowerOptions is a patented suite of search and analysis tools designed for self-directed options investors. Ernie Zarena created the PowerOptions tools about 17 years ago, back in 1997. I started out the same as most of you. When I started working with Ernie about 12 years ago, I was only qualified to trade covered calls and then eventually to buy calls and buy puts and then spread positions. So I spent the first 18 months to 20 months or so trading covered call strategies, and I heard all the hype about generating 3 to 6% per month income and consistently rolling positions and renting out your stock, and it sounded like a great idea. However, over that time period, I realized I was never getting close to the long-term annualized goals that would be realized if I was making 3 to 6% per month. Sure, we can find positions, naked put trades that are out of the money, covered call positions that offer that 2 or 3% return, but when you factor in the losses and you factor in the management of those positions that move slightly against you, you're not getting close to that on a monthly average. Kurt was actually a customer of PowerOptions, and he called up for a coaching session. He wanted to know how he could set up the tools in the married put technique for his RadioActive Trading unique setup. Well, I walked him through how to set it up, and I said, I can see what you're doing here, and I appreciate your limiting risk, but I don't understand how you're going to make money with this position. You're sort of hedging yourself out too far. Well, Kurt invited me to his next free webinar that was coming up. This is about 7 years ago, and I was so impressed with the techniques. I invited Ernie to come and take a look at Kurt's next free webinar, and Ernie was so impressed with the techniques that we decided to partner up with Kurt, and as a result, for the past 7 or 8 years or so, at any given time, 60 to 65% of my portfolio is invested in the radioactive trading techniques, and I've had more success long-term annualized return with the radioactive trading techniques than I had with covered calls, naked put positions, trading spread trades in my portfolio for about a 15-month period. Calendar spreads were a lot of fun for me. Over a course of a 7 or 8 month period, they were the most profitable percentage-wise and monetarily option strategy I've ever traded before. The following 3 to 4 months after that, the calendar spreads resulted in the largest losses I've ever experienced with any options trading strategy that I've played before. And I've done long options, buying calls, buying puts, straddles and strangles, speculation, and so forth as well. Jan asked a question. When did the number of income methods expand to 12? Well, income method number 11, Jan, was released back probably September or October of last year. And income method number 12 came out a few months, 5 or 6 months after that. After the webinar, I'll send you an email, Jan, and let you know how you can access as a Blueprint owner the other materials, the free downloads. Anyone who's a Blueprint owner, of course, can download the free updates anytime an update is made. And I'll show you where you can go to get the information for income method number 11 and income method number 12 as well. Okay. All right, now before we go any further, I'm only going to launch a couple polls today. You might have seen some of these before, but I want to get a gauge of where we all are, of course. So what I'd like to know first is, what kinds of option strategies do you mainly trade in your personal account right now? Are you mainly doing covered calls and naked puts? They're sort of parity trades of one another. Are you trading spread trades, bear call credits, bull put credits, maybe debit spreads? Also include iron condors in that as well. Are you buying options? I'm mainly looking at buying long calls, buying put options, or doing strangles and straddles. Calendar spreads, of course. Are you doing the diagonal or horizontal spreads as well? And if you're selecting other, of course, I left that in there just to see what others are doing. If there's something I didn't define here in the polls, go ahead and send me a quick message with that question pod and let me know which other strategies you're currently trading with most of your portfolio or most of your allocated capital. All right, so we've had the poll open for almost a minute. I've got more than half of you who've already voted in. I appreciate that. We'll leave this open for another 10 or 15 seconds, and if you haven't voted yet, I encourage you to do so. Okay, David, of course, says he's using protective puts, and that's what I expected. I want to see how many people were trading radioactively or maybe doing some ratio spreads or some of the more elaborate spread trades. So, David, thank you for that. All right, let's see, spreads. All right, fantastic. Okay, Bill says married puts was selling weekly calls. Okay, Bill, well, we're going to have something here later on, and I want to let you know how you're doing when we get into that end as well. Okay, Rick also said primarily married puts, radioactive trades. Fantastic, guys. Thank you for chiming in there. All right, let's go ahead and close the poll. I'm going to share the results quickly with everyone else. So we have 30% of our audience who listed that they were doing other, and we heard from some of our attendees that are doing the radioactive trades. 30% of you are doing the covered call positions and naked puts. 20% of you are doing spread trades. I still do spread trades with maybe 5 to 10% of my allocated capital. 10% of you are buying long calls, long puts, straddles, and strangles, and 10% of you are doing calendar spreads, either calendar calls or calendar puts. Fantastic. Now, I'm going to take another one of Kurt's polls here. Let's follow up. Let's follow up here with the second poll. And let's just go ahead and take a look here. What I want to know is, over the last 12 months, 24 months or so, which statement best describes your performance? Did you pick more winners and losers and make money with your trades? Did you pick more losers than winners and you lost money in the last 24 months or so? Did you pick more winners and losers, still manage to lose? Or did you pick more winners and losers and still manage to win? Or are you ready to quit just to stop the hemorrhaging? All right, so I've got about a little bit close to 50% of our audience voting. I'm kind of encouraged by this, and also not, I won't want to say disappointed, but I'm also a little concerned here. So I'm okay. So we're getting representation in all of our categories. Again, poll's been open for about a minute, folks. I'm going to leave it open for another 10 or 15 seconds there. Of course, if you haven't voted, I encourage you to do so. Okay, let's go ahead and close the poll, ladies and gentlemen, and I'm going to share the results with everyone. 10% of you picked more winners than losers and still managed to lose money. We're going to take a look at why. Oh, I'm sorry. Let me refresh that. 10% of you did really well. You picked more winners and losers and made money. That's fantastic. That's encouraging to see. Originally, there was no one who had answered that. It came in later on. 20% of you picked more losers than winners and lost money. Okay. Well, that's what we can expect, even with protective strategies at times, although we're going to take a look at that as well. 30% of you picked more winners than losers and managed to lose. We're going to take a look at why. And 30% of you, equal to the number of investors that are doing the married puts or said other, picked more losers than winners and managed to win. And 10% of you, unfortunately, are ready to quit just to stop the hemorrhaging. Well, let's hide that, and let's see what we can do about that as well. Now, the initial setup of a radioactive profit machine is a married put position, but is a unique form of a married put position. Many of you have seen free education on your broker or on the internet that a married put consists of buying stock. I may go out today and buy a $50 stock that I'm bullish on, but I want to kind of insure it a little bit better than a stop order, so I may look to buy cheap insurance. I may buy an August or even a July, 11 days out, 12 days out put option at the 45 strike or maybe the 42.5 strike and only pay 80 cents for that protection. The problem with that is it still puts you in a range of double-digit risks. In my scenario, if I bought the stock at 50, and I mean double-digit percentage, of course, but if I bought the stock at 50 and I bought a 45 put for 80 cents, my total cost basis would be $50.80. And if the stock collapses and drops below 45, I now have the right to sell my shares of stock to someone at 45, but I'm still taking a $5.80 loss on my investment. That's over a 10% loss on your position. And as many of you know, if I take a 10% loss on a trade, I don't need a 10% win to get back to break even, which are hard to come by as it is. But I'd need an 11% win on my next trade just to get back to break even. And that's a slippery slope we call gambler's ruin. And if I have a 25% loss on a position, sudden black swan event or just an unexpected event, the stock plummets 30%, blows through my stop order, for example, I don't need a 25% gain to get back to break even. I need a 33% gain to get back the money that I lost. So the standard married put does control your risk, but it doesn't put you in the proper setup where we want to see single-digit risks. Well, what we're going to do with our unique setup is we're going to buy stock. We're going to buy a put that's in the money, higher than our current stock price, and at the same time, we want it to be at least 5 months out in time. Those of you that are doing income strategies, covered calls, naked puts, credit spreads, you know that to maximize your annualized return, you want to sell week by week or month by month. You want to sell shorter term. The option that's 6 months out in time is not going to be 6 times the premium of the current option that you're selling. Well, that same concept works in reverse when we're buying options, whether we're buying for protection, whether we're buying calls or puts speculating on a market movement, or maybe we're buying a leap call or a leap put for our calendar put positions, or even 3 to 4 months out in time to try to sell weeklies against it. And that's why when we're doing this insurance, we want to buy the put that's 5 months at a time. It's going to lower our annualized cost for the insurance, and the time decay that we're going to see in our protective put option is going to decay much more slowly than if we bought the shorter term. So that's why this unique setup is very different than just talking about a standard married put using an out-of-the-money near-term put option as well. Okay, that's an interesting concept here that Rick mentions, that I've been having good luck with buying one more put than the 100 shares of stock I bought and adding a call when the stock trades above the 8 DMA. And I'll agree with you, Rick. That's part of what income method number 12 is, as a matter of fact. We won't get into that today, but the recent market that we've had and the recent pullback we've seen over the last 2 to 3 weeks, and little hesitation and some big movements we've had, a ratio radioactive trading setup, which is discussed as well in the blueprint, is something that can be useful over time. It just, unfortunately, if it goes the opposite direction, you're now fighting the loss of 2 time decays as well. Now, this is a historical trade, and we're just going to use these numbers from a previous position I have set up, but the numbers and the concepts work the same. We're going to look at a modern trade and modern trade comparisons coming up in just about 20 minutes or so as well. So here's a basic view of a radioactive trading setup that I entered in my portfolio back in 2011. PXP, Plains Exploration, which no longer exists, it was bought out a year or two ago, was trading at 35.08. Now, instead of buying the stock at 35.08 and in June buying, let's say, a July 30 put option, I went out to January 2012 and purchased a 40 strike put at 7.25. Now, this does increase my cost basis to $42.33 out of pocket, but I'm guaranteed to get $40 back. And so this gives me a total risk in the worst case scenario of $2.33. If the stock dropped to $1 per share, I can force someone to buy my shares of stock at 40. I'm only losing $2.33, or 5.5% of what I invested in the position. Now, another side note, one of the things we really focus on here at Radioactive Trading is position sizing. In my portfolio at the time, my portfolio value, the investment amount, I should say, that I was allocating towards trading was about $40,000. Okay, so as a general rule, what we want to do with our radioactive trades is I want to make sure that the total risk on this position is no more than about 1.5% of my total portfolio value, which means roughly I don't want my total at risk monetarily to be more than around, let's say, $600 or so. So with this trade, I was able to do 200 shares and 2 puts, so my maximum monetary risk was $466, even though I did allocate about $7,000 in, I'm sorry, about $8,400 into the trade. Well, my maximum risk is only $466, which is less than 1.5% of my total portfolio value. Okay, so that's just the position sizing that we take into account. I could have gone a little bit higher, gone up to about 2.2% and done 300 shares and 3 puts, but at this time I just decided to do 200 shares and 2 puts. But for our purposes, we're just going to talk about the numbers, assuming 100 shares and 1 put contract as well. Okay, so that's just a brief discussion, one of the 3 core principles, position sizing. So here we have the basic setup, and what do we look at when we enter a married put that's different than a covered call or a naked put? Well, the main instance here is the infinite upside profit potential. When I opened this particular married put and I bought stock at 35 and I bought the 40 put, it's because I had the expectation that the stock would be trading up at $40 or probably around $38.50, $39 per share for the next 30 to 60 days. On Thursday, we're going to take a little bit of a different look at radioactive trading. We're going to go into sort of the research and analysis using power options and finding a new trade. But using the tools, of course, in my analysis, I picked a stock that I felt had the potential to move up 5 to 8% or so in the next 30 days. So I picked a strike price that not only matched my risk, but was close to where I thought the stock was going to be trading at that time. Now, I'm not always right. And of course, because I'm not always right, that's one of the reasons why I want to use the put option. So in case I'm wrong and the stock plummets, I recently was very wrong or had an unexpected event on one of my fusion trades at Radioactive Trading. Iconics dropped from about $42 per share. It's currently trading at $24.34. I'm losing about 6% on the trade, but the stock drops close to 40% of its original value when I entered the position. In any case, we have an infinite upside profit potential, which we don't get with a covered call or a naked put. We've capped the upside by selling the call. One of the common detractions when an investor sees the radioactive trade is to say that, well, I don't see why you guys are doing this. You're trading against yourself. You're bullish on a stock, but you're adding a bearish sentiment by purchasing this put. Buying a put is a bearish sentiment on a position. Well, it is. That's correct. but I'm not trading against myself. I'm insuring the $7,000 or $8,000 in capital that I invested into this position to a maximum loss in the worst case scenario of only 5%. It's guaranteed, unlike a stop order. When you trade a covered call, one of the most bearish things you can do is sell a naked call. When you sell a naked call, of course, you have a potential profit, but an unlimited risk to the upside. So how is that any different than doing a married put? Because you're adding the most bearish thing you can do to a stock position to enter a covered call trade. So I always have fun with that argument when someone says you're trading against yourself. Actually, no, I'm not. I'm insuring my position, which is very smart. I feel that when you're doing a covered call, you're technically more trading against yourself. In any case, here is the standard profit and loss of a married put position. For our PXP position, remember my cost basis was 42.33. And you'd say that the break even now is 42.33 on a stock that's trading at 35. That's correct, but remember my put was all the way out to January. It was about 6 months out in time from when I entered the position. Is my static break even 42.33? Absolutely. If we held the position all the way to January expiration, I chose to make no adjustments on the position, I would need the stock to be trading at 42.33. But what you're looking at here, this green line, represents the current stock price, and our curved red line here is showing us the profit and loss essentially at the halfway point, halfway between the time I entered the trade and January expiration. And because our put, because we bought that far out in time put, which doesn't decay as rapidly as the near-term put, and at the same time, it doesn't have a one-to-one delta, meaning if the stock moves up $1, I'm gaining more on the stock than I'm going to lose on my put option. The curved red line shows us that at the halfway point, we have a break even more of around $38, $38.50. And again, I could exit this position early as the stock moves up, take a profit, but of course we discussed the 12 different income methods that we're going to use as the stock goes in our desired direction or does not go in our desired direction to further limit this risk and potentially bulletproof the trade as well. Now, before we get into the trade comparisons, we already talked about this, unfortunately. I skipped ahead of myself, but there are two basic components of the RPM. We're going to go long stock, and we're going to buy an in-the-money, far out in time put option. And we talked about, are you adding a bearish instrument to a bullish trade? Yes, I am. But it's an insurance policy. I'm not trading against myself. I'm insuring my invested capital into the position. Now let's navigate over to the trade simulator tool at PowerOptions. We're going to address some of those polls that we just discussed there. And we're going to show why some of you are not making the returns that you expected for the positions. So what we want to do now, let's go over to RadioActiveTrading.com. And at RadioActiveTrading.com, if you click on the Resources tab, you're going to see a couple of free resources. Number one, if you haven't done so already, you can go ahead and register to get a free 2-week trial at PowerOptions. And most of you I see here have already used PowerOptions or are currently subscribers to PowerOptions as well. What I want to do is take a look at the Trade Simulator tool. The Trade Simulator tool is going to allow us to put in sort of a track record of what we could expect for our positions, or our trading strategy, I should say. Meaning that let's say you and I were just going to buy stock, and we're going to go ahead and set in a target price for our stock position that we're going to liquidate of a profit if we hit 10%, and we're going to close the position if we see a 10% drop, or maybe we'll set a 10% stop order. Now we're going to flip a coin 100 times, and we're going to assume that heads we win, tails we lose, and if we have a 50% win-loss ratio, and we started out with $10,000, of course, we're going to take 50% per trade. Down below, it's going to show us the track record of what we'd expect to see out of that random 100-time flipping the coin. So standard stock, just buying stock, taking a 10% gain if we're lucky, closing for a 10% loss if it drops against us, and how would we do? Okay, well here we see that if we are right 49% of the time, we are wrong 51% of the time, naturally we'd expect to lose money. We were wrong more often than right. We started out with $10,000, and at one point we had about a 20% gain, but over time we're going to give all of that back. So naturally we just need to be more right than wrong. Okay, so here's an example. We were right 54% of the time, only had 46 losses. We won more often than we lost. At one point, we were about a 40% gain. We ended up with about a 30% winning record. But at one point, we were down 30% as well. Now we had 30% of our audience say that they were doing covered calls and naked puts. And we had about 30% of our audience say that they actually picked more winners than losers and still managed to lose money. Well, are they the same? Let's take a look. Are they the same 30%? Let's take a look. If I entered a covered call position, I may expect on the high side to look for a 5% return if assigned. It's very speculative. I can set my loss limit to about 10% using a stop order or other techniques, but usually using a stop order. And you say, well, I'm going to set my covered calls to be slightly in the money, so I'm going to have a better track record. I'm expecting to be right 65 or 70% of the time. So we're going to set our probability of loss of only 30%. And again, I'm going to start off with the same $10,000, and we're going to invest 70% of our capital per trade. Now, what just happened here? We flipped our coin 100 times. 64% of the time, we were right and we earned our 5% return. 36% of the time, we lost and we took a 10% hit. So we were right 64% of the time. At one point, we lowered our account down to about 62% loss, and we ended with about a 34% loss over time. Okay, so this is one of the reasons. Let's try to be right more often than wrong. Let's see if we can get a better winning record. Well, there's 65 and 35. The numbers didn't change, but at one point, with a random string of wins, we were up 60%, but we ended up down about 23% of our portfolio, making 5% return when we're right, losing 10%. Let's get higher. There we go. Okay, so now with a covered call setup, if I'm right 72% of the time looking for a high win of 5%, loss limit again at 10%. We almost doubled our money at one point. We had a nice string of winners, so we never dropped below 92.65. We ended up technically with a 50% gain after 100 trades. But we had to be right 72% of the time. And that's tough to do even for spread traders that have a higher probability of a position expiring worthless. These are the numbers Kurt put in for a covered call. I think a more realistic return, by the way, current volatility in the market, although we've seen some fluctuations recently, but an average return for a covered call trade right now is about 3% return if assigned for slightly in the money or at the money. And let's follow the O'Neill rules at Investors Business Daily and set our stop order about 8% instead. Still expecting to be right 70% of the time or so, taking our $10,000. But notice here, if we're right about 60% of the time, we have a terrible track record. So let's increase that, shall we? Let's find a better winner. There you go. How about this one? 74% winners versus 26% losers. We make 3% return if assigned when we're right and the stock's called away. Set our stop order at 8%, and that's assuming no drastic declines that can happen overnight. We see a stock that drops 25%, just blows right through that stop order. We get filled for the 25% loss, not the 8% loss. We were right 74% of the time, and at one point we had a 20% gain. But at the end, we only made about 4% after 100 trades. That's a lot of work with an extremely strong winning track record to just make 4%. Now, very quickly, let's navigate over to credit spreads here, a default view. Credit spreads, I may look at a credit spread and want to get a 75 or 80% probability. So that means what I'm going to be doing is I'm going to be selling, let's say stock trading at 50. I'm going to be selling maybe a 45 strike put and buying a 42.5 or a 40 strike put. I've got a 5-point strike difference. I make a 50-cent net credit. My true risk is only $4.50. So that's about 11% return on my investment. I'm going to look to stop the position if it moves against me, of course, if the stock falls. And what I may look to do is close the position if my debit is maybe 3 to 4 times higher than that. Okay, so if it's about a $2 debit to close the position because the stock moved against me, or maybe $1.50. So we're looking at a loss limit of 50%. And again, because of that high probability, we're looking at an 80% win-loss ratio. We're expecting a probability loss of only 20%. And down below, we see we can have a very, very strong return with this leverage credit spread ratio, looking to make 15% when we're right, closing the position if we hit that $2, $2.50 loss. Good probability of about 80%. And if we're right 84% of the time, we can take our account, we almost multi-factor of 10 at one point, because we had a lot of winners in a row, and we quadrupled our money, a little bit more than that actually, 450% return at the end. But what about just having closer to an 80% gain? There's 85, you see about the same numbers. There's 82. Now notice we have a problem here. 82% winners, we did almost take more than double our money at one time, but we also hit a low value of about $1,100. It's almost a 90% loss on our portfolio, and we ended up with only a 50% gain. Well, that's great, but would we have stayed in through this loss of about 90%? Probably not. At that time, we probably would have changed our track record. 83% wins again. I'm trying to find something a little lower. Here's one. You're right 65% of the time almost. You didn't get to 100 trades because you went below $250, that 2.5 point spread, for example, and you were unable to keep trading in your account. Trying to find a good range here. Here's one. Spread trades and the leverage positions, of course, 78% winners. Or we started off with a very good track record here. We took our account up by 50% almost within the first 5 trades. But over time, we took our portfolio down to about 82% loss. And it's because of the lie of leverage. We're putting in less capital, so it looks like a good position. But at the same time, those 50% losses, even though we're only incurring them about 20% of the time, they're taking our account down too drastically. If we have a string of losers in a row, look here, we went down to 3,000, 19, and we're only 38 trades in. We've only got $1,200, $1,300 remaining. So that's the lie of leverage over time, especially if you're trading credit spreads on volatile stocks because you're looking for that higher premium, and that stock overnight gaps down below both strike prices. You're taking a 5-point loss. You've probably just wiped out 10 to 12 previous trades. So how about this? How about we take a look at keeping our return maybe around 5 or 6%, the upper edge of our covered call trades, and still lower than percentage return we'd see in a spread position. But at the same time, I'm going to keep my losses to about 4.5 or 4.4%. And my probability of loss, I'm going to set that to 50% as well. We're going to take 100% of my capital invested in trading also. Let's see how that would perform. Okay, so naturally here, we see that we have more losers than winners. We lost 45% of the time. I'm sorry, we lost 55% of the time, only won 45% of the time, and we ended up behind. We're only 28, 29% down on our track record. Let's see if we can get that to 50-50. Here's an interesting scenario. Remember how in covered calls we were right 74% of the time or so, and we still had a losing track record. And with the spread trades, as soon as we dropped below an 80% winning record, we had significant losses down to 90%. But if I set a realistic target return, and that's actually on the low side from what Ernie and I and Kurt actually realized with our radioactive trades on our winners as an average. But if I control my risk, the only thing I can control in this position, and even with a 50-50 win-loss ratio, we're actually making money more than we did with that one covered call that only made 4%, with winning 65% of the time. Okay, so this is why we use the radioactive trading techniques, and this is why we focus on limiting risk first, because when I control my risk and I keep every loss down below 5% or even in the 4% range, I can be wrong more often than right and still make money. Let's take a look at just a 4% loss limit and earning an average of 6% on our winners, and let's see what happens. I want to get to a scenario here. There we go. Because I'm controlling risk and I'm guaranteeing it with a put option and keeping my risk to 4%, and I'm taking 6% on my winners, even if I am wrong more often than right. Here we had 58% losers, 42% winners. Even if I'm wrong more often than right, we can still have a winning track record over time. Okay? And that is the real issue, why we're trading radioactively. And before, just remember, let me go ahead and share this again. 10% of you picked more winners than losers and made money. That's fantastic. 20% of you picked more losers than winners and lost money. Well, how about if you controlled risk in that factor? Maybe you still picked more losers than winners, and we might have made money, as we just saw with the trade simulator. 30% of you picked more winners than losers, but still managed to lose. And that's one of the reasons why we saw with the covered calls, with the credit spreads, you were right more often than wrong, but you still lost money. And it's because we need to spend more time on focusing on limiting our risk on the position. And of course, 30% of you picked more losers than winners and still managed to win. And ironically, at the time, we also had 30% of you who were doing other trades and said you were doing protective puts and the radioactive positions as well. So we can see that play out over time. All right, let's get back over to our main presentation now that we've illustrated that. We want to get into some of the trade comparisons here, the common questions I get asked through emails and through phone calls here. Looking at what we just saw with the radioactive trading setup, we've just shown why we feel you should be trading radioactively, why we advocate it so much. Because you're going to have strings of losers and winners, but if you control your risk, you can actually have more losers and winners over the course of a year period or even longer and still manage to make money. It's the only strategy I've seen where that is possible. Okay? But a lot of you don't want to invest in stock. You don't have the capital, or you don't want to see 10, 20, maybe even 30% of your current portfolio value allocated to one position. So if I got $30,000, I'm looking at a $50 stock. It's going to cost me $10,000 to buy 200 shares and 2 puts. I don't want to see a third of my account allocated to one trade. So aren't there cheaper ways and synthetic ways to do exactly what we just saw with that profit and loss chart of the married put position? Aren't there cheaper ways to own stock or mimic stock ownership? All right, now the first comparison, you're all savvy options traders, you're all actively trading options. You go to a seminar somewhere, an introduction to investing seminar, and someone says, yeah, you can make good money by buying stock if you follow these rules. What is one of the first things you might say? Well, rather than buying stock, why don't you get paid to potentially own those shares of stock? Instead of buying a stock at $51 per share, why don't we sell the 50 put? And when we sell the 50 put, we're going to generate maybe 80 or 90 cents a premium. So if the stock does accidentally fall below 50, well, we're going to get put the stock, but we're going to only have a cost basis of maybe $49 or $49.20 or so as well. Okay. And at the same time, of course, what happens if the stock stays up? Well, hey, my put expired worthless. I kept the premium, and now I can sell a higher strike put or sell a 52.5 strike put, and so on. Sell a put, collect the premium. You may be forced to buy shares of stock at the strike price, but you're looking to get into stock at a discount. Now, by itself, it's a parity trade to a covered call. Also, we have the same risk-reward profile as you do with a covered call position. So an investor takes a look at the married put position and says, I won't want to buy stock at 35.08. Rather, Mike, what I would have done when you bought PXP is I'm going to sell to open a July 35 put at $1.24 premium. This was the real price at the time. The maximum profit, of course, would be $1.24. If the stock stayed above 35, our put would expire worthless. We keep the $1.24. Now the maximum risk, this is if the stock dropped to zero, is $3,376. Probably not going to happen, but that is the maximum risk. We'd have to buy shares of stock at 35. It's currently valued at zero. Hey, we keep our 124, fantastic. So we'd have a loss of $3,300. The naked put profit and loss chart is the opposite. Same with the covered call. It's sort of the opposite of the married put play, isn't it? This cuts our winners short. If PXP rallied and moved up to $41, $42, $43 per share, we're only going to make $1.24. We didn't take any other advantage of that movement of that stock. Does it let the losers run? Sure. If this stock gapped down 3 weeks later or 2 weeks later and it drops down to $28 per share, even if we had a stop order in place, we're going to be forced to buy shares of stock at 35, and we've got a stock trading at 28. So now we're going to have to manage that position, probably doing covered calls or collar spreads to try to get back to break even. And that is a long wait once you've suffered a 20 or 30% loss and you're only able to generate 2 to 3% on a regular basis against it. So this is what we mean here. Same kind of profit and loss chart you see the covered call. We've cut our winners short, and we still have allowed our losers to run. We want to reverse that, which we've already seen that the radioactive position does for us. We cut our losers short, we allow our winners to run. So no one wants to do that. You want to protect maybe this naked put position. So you'd say, okay, Mike went into PXP, bought 100 shares of stock at 35.08, bought a January 40 strike put for about $7.25. What if I did the same combination but used the naked put instead? So instead of buying the stock and putting out $3,500, you're going to sell the July 35 put at $124. You're going to buy the same protective put that I bought at $7.25. So now your total debit into the position is only $6.01. If you did one contract, you'd have $600 allocated to the position. Okay? And that means that you could potentially buy stock, of course, at $33.76. If the stock drops below 35, you're now going to have a cost basis of $33.76. Now this here, we see the maximum risk, of course, is 601. Now that's for one contract and one put. Remember, my maximum risk in the PXP Married put was only $2.33 for 100 shares. So it's about a third of what we're looking at here. The max profit is $92. It's not bad. It's a 15.3% gain. But remember what we just saw with the trade simulator tool. If I have a track record where I'm looking to make 15% when I'm right, but I'm risking 100%, let's say we wouldn't even take that. Let's say we'd only take 50% of this position. But that looks a lot like the credit spread ratio we did, didn't we? And long term, this type of setup here, we would need to be right, as we saw, over 80% of the time in order to make long-term profits. So here is the profit and loss chart of trying to enter a radioactive trade using the leverage or using the naked put position as a way to get stock at a discount. The problem here is that we have a capped gain, of course, at 15.3%. The stock stays right around 35 or drops a little bit below, we're going to be in a good position. The lower break even here, this is sort of our range closer to 33.76. Really 33.76 here, our cost basis would be here. But this is taking into account the remaining value of the put option. So let's just look at our lower break even here, probably at about 31.10, 31.20. Remember what I said when I looked at the married put. Why did I choose the 40 put to begin with? It's because I had a target price that I thought PXP was going to move up to about 39 or 40, 38.50 to $39 in the next 30 to 60 days. So if the stock's trading in that range, what I've done here is I'm taking a loss with this setup. Okay, I have capped my gain in this position, opposite of what I wanted to with a radioactive trade. My risk, that $600 risk we saw, is actually to the upside in the direction I thought the stock was going to go. Because as the stock moves up in price, we can't gain anything more on our July put. We can only gain the 124 maximum we received on the position, and as the stock's moving up, our put is declining in price. In the RPM position, of course, as the stock moves up in price, we're gaining more on the stock than we're going to lose the intrinsic value in the put, so we're going to see upside potential profit in the direction we thought the stock was going to go. So is using a naked put or a calendar put what this is, but selling a short put instead of the stock and still having the same protective put in place, is that going to be more profitable long term than doing a radioactive trade setup, the initial RPM setup by buying stock and buying a put? The only yes answer to that question is if you consistently pick stocks that trade in a short trading range, remember, for only the first 30 days or so on the position based on where you sold your put. So if you can stay within this range in the first 30 days and either your put expires or you get put the stock down here, or maybe you just let it expire here and you sell another put going forward, well, and then the next 60 to 90 days after that, you see a 5 to 6% gain. So let me rephrase that. If you can consistently pick stocks that don't move more than 0.5 or 1% in the first 30 days, but are going to move up 5 to 8% in the next 60 days after that once you purchase the stock, then yes, you may slightly outperform the radioactive trade that I was in. I don't know how many of you can consistently do that over time, but that's what we're looking at here. This is why this technique does not work as well. Okay, and we've got another question that came in from Sunil. And Sunil, if you allow me some time here, probably in the next 5-10 minutes, I'm going to address your question right before we start looking at a current position and running the comparisons as well. But let's go through our other two comparisons and wrap up this one as well, Sunil, and I'll get to your question right away. Okay, now let's just recap real quick. Remember, when I opened the trade, I expected the stock to move up 5 to 8%. Trying to enter the position at a discount, get into the stock in the discount while having the protection in place, gives me the margin of only a smaller amount, $600, but now I'm trading against myself. I'm in a bearish trade on a stock that I just researched that I feel bullish on. You're trying to time your position. You've got to pick a stock in this scenario that's neutral or only going to move up 1 or move down 1% in the next 30 days and then move up 5 to 8% the following 60 to 90 days after that. That's very difficult to do. If the stock goes up as you expect, you're going to suffer larger losses. You have now traded against yourself and entered a bearish position, and you may have to scramble to buy stock if it moves up in price because you're losing the delta on the long option. Quick side-by-side comparison. Remember, my radioactive trade for 100 shares and one put was $2.33. or 5.5% of the $4,233 I entered into the position. The put risk, the calendar put here, trying to enter stock at a discount is only 6% or $6, but that's 100% of what you invested. The RPM forces an ideal size trade. We saw that if I use 200 shares, I'm only risking 1% or less of my $40,000 trading capital. Here with the calendar put, you might be disciplined to only enter in one contract, but this comes with the risk of over trading. You see me open a fusion position where I allocated $4,200. You decide to do it with a calendar put and only invested $6 per risk or $6 debit. But this allows you to trade up to 7 contracts to allocate the same $4,200 into the trade, but now you're risking 100% of that $4,200. The RPM has unlimited upside because I did look for a bullish stock. We have a capped gain on the calendar put, and the risk is to the upside in the direction that we thought it was going to move. Okay, so that's our first comparison when taking a look at using the naked put to enter in the stock at a discount. All right, now Sunil, again, let me move through these other two very quickly before we get to your question, then we'll move on to a real-time view of a current trade we might open radioactively and then look at the 3 comparisons or others that we're going to look at. Now, what is another way that investors might look to mimic stock ownership or get into stock technically at a discount? Well, of course, investors often use leverage. And by using leverage, we mean you're going to buy a long call. Now, to mimic stock ownership, I may buy an in-the-money long call with a high delta. So with my stock trading at 35, I might look to buy a 30-strike call several months out in time that has a delta of maybe 0.8 or 0.85. So for every dollar the stock moves, I'm still getting close to 85 cents or 90 cents for that movement. But I'm only going to pay a lower cost, some intrinsic value plus some time value to enter in that call that's going to gain as the stock moves up. So are we going to do better than the radioactive trade if we keep the same protective put we were going to do, but we don't buy the stock? We buy a leap call or far out in time call that's slightly in the money because we're paying less cost, so we have to do better. Well, if I bought an in-the-money long call far out in time and still bought that 40-strike January put option protective put at the same time as well, you're going to create an in-the-money long strangle. And both your call and your put are in the money at the time. A standard strangle is usually a combination of buying an out-of-the-money call and an out-of-the-money put. But when you buy them both in, we just call it an in-the-money long strangle. You do have infinite upside profit potential, same as an RPM, and you have infinite profit technically to the downside. Of course, only limited to the stock going to 0. The total risk is the cost of the time value for both options. So again, on June 20th, 2011, I could have entered the in-the-money long strangle on PXP. We would have bought our January 40-strike put at 725. Now that put, when we open against the Mary put, is 14% in the money. That risk we saw, the 233, that 5.5%, that's the time value. That's the only risk we take in a married put position. Delta is around 0.64, negative 0.64. Instead of buying the stock, I could have entered an in-the-money long strangle by buying the January 30-strike call at 735. It's about the same range in the money as our put option. Remember, our stock's at 35.08. We've got a slightly higher time premium, 5.8%. Our delta's close to 80. It's a 0.77 delta at the time. Now, my total invested, if I just bought one contract of the call, one contract of the put, would be $14.60 or $1,460. Roughly a third of the $4,233 I was going to invest in the radioactive trade. Now, the way it works out, though, is my maximum risk is going to be $460. Now, this is double the risk that I had. So if the stock trades right at 35, what would happen? If we held it all the way to January expiration again, stock was trading at 35, your 40 put would be worth 5 points. Your January 30 call would be worth 5 points of intrinsic value. So you get 10 points back, but you'd lose that 460, the time value of the two options. So this is double our risk that we had on the married put of only $2.33. But here's the kicker. It's 31.5% of our invested value. And again, you might look at this and say, well, I saw Mike do 100 shares of PXP and one put option, so his total investment was $4,200. Here, I'm only investing $1,460, so I could do 3 calls in 3 puts and the same 4,200 invested, but now you'd be risking $1,380 monetarily compared to my $233 that I have at risk. Okay, so it's that risk again of overtrading with the leverage. So we have a 31.5% risk. We still have infinite upside. We've solved that problem we saw with the calendar put trade. We still have the infinite upside, but we're risking double monetarily and a large percentage of our investment. We run the risk of overtrading. And here's that profit and loss of the in-the-money long strangle. If I entered PXP and the stock dropped 15 to 20%, and you enter this long call, the in-the-money long strangle, would you be doing better? Yes. You'd be at a smaller loss in this case, potentially, of maybe only $20 or $30, or you might have a small gain on the position, even at the halfway point. If the stock moves up 20 to 30%, or let's say it moves up 25%, gets close to 50, are you going to have a higher return on the in-the-money long strangle than I would on my married put? Potentially, yes, depending on the time decay, the two options change in volatility as well. Your put's declining, so is mine. I've got a 1 delta on the stock. You're getting closer to a 1 delta, but you used less money to get into the position. But again, how often do you consistently pick stocks that move up 20 to 25% within the first 30 to 60 days, or drop out of bed and fall 25 to 30% within the first 30 to 60 days? The difficulties with the in-the-money long strangle compared to the RPM is you're increasing your percentage and your monetary maximum risk because you have 2 time values as well. An interesting thing about the in-the-money long strangle is that notice here between this range, the upper break-even, of course, and the lower break-even, around $43 per share, and at the let's use the halfway point, it's about $40 to $40.50, a lower break-even at the halfway point, let's say around $29.80 or so, probably a little bit lower than that, probably around $29.10 or $29 per share. That's your halfway point, upper and lower break-even. The reason why those break-evens are so extended is because you're starting off the in-the-money long strangle delta opposed, not delta neutral, you're delta opposed. If the stock gains 1 point, as we saw before, we're going to lose 65, 66 cents on the put. We're only going to gain probably 70 cents on the call. All right, so we're not really getting ahead. We have a gain of 5 cents. In the radioactive position, remember my delta was only 0.65, so if the stock moves up 1 point, I'm gaining 35 cents on the position. My delta is lowering on the put. If the stock goes up another $1, I'm going to gain more. Okay, we're not losing a 1-to-1 ratio. I've run several examples of this for investors over the years, saying, well, I was thinking about doing the in-the-money long strangle on stock XYZ. How would that perform? And what we do is we pick the married put that we would use. We show them the in-the-money long strangle. We track it for 30 days. And what we see is you need the larger movement to realize the profit. In normal market conditions, a move of 2 to 3% in one direction or the other over a 20 to 30-day time period, the married put always outperforms every in-the-money long strangle comparison I've done for investors. There's a potential, if the stock moves up 2 to 3% in the first 20 days, I'm going to have a profit on the married put position. The in-the-money long strangle is still behind. It's still losing money because the time values and the decay are fighting one another. What you gained on the call, you're losing an equal to or maybe a little higher on the put option, plus you've lost time value, 2 to 3 cents or 5 cents on both, but you've lost time value on both options. If the stock falls in price, the radioactive trade is, let's say, 2 to 3%. The radioactive position is only down about 0.5 or 1% monetarily. So I'm probably losing 40 or 50 cents on my married put. The in-the-money long strangle will have a larger loss because you did gain some on the put, but you're losing an equal amount at the call at this time, and you're losing time value of those first 20 to 30 days as well. So long term, in normal market conditions, this in-the-money long strangle will not do better than a radioactive trading position, the married put position. Again, side-by-side comparison, we've already talked about this. You're in the money long strangle, you're doubled the risk, but your percentage is extremely high because of leverage. And with leverage comes the risk of overtrading. You start off delta opposed. It's not a neutral position. You're delta opposed. You need a wide swing, maybe an 8 to 10% gain over that first 30 to 40-day time period or so in order to start realizing a profit, because the two options are fighting against each other until one can take over. We start off with a positive delta with the radioactive trade on our bullish position, and we're forced into an ideal size trade and don't risk the leverage trading. Now, as I mentioned before, I do have various white papers, some comparisons of the in-the-money long strangle versus the RPM. I'm going to update those in the near future. So if you'd like those sent to you, just send me an email to support@RadioActive Trading and say in the money, just to call it the title, the subject, I'm sorry, in the money long strangle versus RPM, if you'd like those sent to you at any time. Okay, and I'll make sure to get those to you. Probably won't, actually I think I'm going to update those as well later on. Okay, Bill, I'm going to have to get to that question later on as well because we want to do our last, I'm going to get your question and Sunil's question right away. Let's do our last comparison real quick, and this is the common one, and then Bill, I'll get to your question right away. I know we're close to the 1 o'clock hour. We're probably going to go 10 to 15 minutes over, but I'm going to discuss that because that's important. I want to show two issues with that, Bill, and I'm going to address it with that as well. Bill's question is in relation to using the RPM put so that you can finance the put with weekly options. You got to be careful not to trade against yourself. I'm going to show that in just a minute. Okay, now the big detraction. Our profit and loss chart for the married put is the exact same profit and loss chart you see as buying an out-of-the-money long call. Okay, the setup that you're doing with the radioactive trade is the same as buying the far-out long call, but buying the long call is better. Well, how can something be the same and better? All right, well, the people who are saying that, they're saying it's better because you're using less capital, once again, into the lie of leverage and speculation with leverage. And we're not going to worry about the blog right now, but let's review our setup again. Buying stock of PXP at 35.08. Buying the 40 put for insurance at 7.25. Total invested is 42.33. Guaranteed exit if the stock collapses at $40. My total at risk in the worst case scenario, remember if I only occurs if I hold it all the way to expiration, make no adjustments, is $2.33 or 5.5% of the capital I invested in the position. On that same day back in 2011, I could have bought the January 40 call. The ask price, midpoint, was only $2.30. I have an infinite upside. My maximum risk for one contract is $2.30. So we lowered our current risk by 3 cents. This must be a superior trade. So why are we not advocating just buying calls on your instead of entering the radioactive trade and using less capital? Well, number one, here's a profit and loss chart of our radioactive trade. You've seen that 3 or 4 times. And here's the profit and loss chart of the long call. It's not a copy and paste. The prices were different when I took these screenshots, but we have the same, very similar risk-reward profile. Once again, RPM, and once again, there's a profit and loss of a long call. Now, we are not saying that the long call and the radioactive position do not have the same risk or reward profile. We agree with that. The married put and buying a long call have the same exact risk-reward profile on a profit and loss chart. The problem comes with discipline and what we talked about when we looked at the trade simulator tool. Once you start using leverage, you can get hurt very quickly. We want to, in radioactive trading, one of those 3 core principles, again, is proper money management and forcing an ideal size trade. The long call risks 100% of what you invest in the position. You're going to say, but Mike, the investment was only $2.30. I'm doing better than you. I'm going to have a 3 cent less risk. Agreed. If you were disciplined enough to only buy one contract of that leverage position, and if you left the remaining amount of capital on hold in your account, but that's not what you're going to do, is it? Let's compare 2 accounts. On my left is my account. I've got $100,000 of free capital. I've got $17,000 of free capital to trade. The RPM cost here for my PXP position would have been $42.33 with a risk of 5.5%. With my free capital, I can buy 400 shares of stock and 4 puts. My investment would be $16,932. But remember, because I have the 40 put, I'm guaranteed to get $16,000 back. So I'm only risking $932 total, or 1% of my total $100,000 account. On the right-hand side is your long call portfolio, let's say. You currently have an account size as well, valued a total of $100,000. You've got $17,000 of free capital invested. I apologize for the chicken scratch up there. The call cost is $2.30. The risk is $2.30, 3 cents below the married put. But you can buy 73 contracts of that January 40 call, and you'd invest $16,790. But remember now, you're risking 100% of that investment, or 16.7% of your total portfolio value. Okay, now I always set that up and everyone's going to call me on it, and that's fine. That's an exaggeration. I know that everyone online would not invest that full $17,000 into that one call position no matter how confident you were the stock was going to move up in price. But let's be honest about the nature of investors and using leverage. If you were in that past comparison, if you were disciplined enough, sorry folks, there we go. If you were disciplined enough to only buy 4 contracts, seeing that I bought 400 shares and 4 puts, you only bought 4 contracts would put you at a risk of about $922 or so. Now you can say that you have a risk of 1% of your total $100,000 portfolio. But even if you were disciplined to only keep the cost to 1% of your total portfolio value, what are you going to do with that remaining $16,078 that you have? Are you going to leave it on hold in your account so it's not risked in the market? No. You're going to buy long calls on other stocks, aren't you? You're going to buy 5 calls of stock ABC. You're going to buy 3 calls of stock XYZ. The long call can only be considered a true parity trade to the married put if you risk the same monetary amount. So here we go again, 400 shares and 4 puts. Total cost of my portfolio was $16,932. My $100,000 portfolio, I'm risking $932. That's only 5.5% of my total investment, but it's less than 1% of my total portfolio. You buy 4 calls with a cost of $230. Your cost is $920 for the 4 contracts. You're risking 100% of that $920, but that's okay because it's still lower risk than the married put, and it's less than 1% of your portfolio value. Now, the only way that these are even close to true parity trades at this point is if you take that remaining $16,080 or $17,000 of free capital you had and you leave it on hold in your account or an interest-bearing account as well. Real quick question. Bill says, by using your married put trade, do you have the chance of a long-term gain? Oh, absolutely. Absolutely. I mean, that's what I've been averaging about 10% per year with following the radioactive trading techniques, which is why I'm still allocating 60% of my trading capital to those positions. Those of you that are in Fusion right now, you know I'm just below that right now in the 7th month in, but I'm not making the 10% I usually do right now. I'm not averaging that right now, but I'm still positive in my portfolio because of the controlling risk. The gains that I've been experiencing over the last 6 years with radioactive trading have outperformed every other option strategy I've traded over time. Even with tweaks and making adjustments and so on and so forth, I've had better luck here with the radioactive trading techniques than I have with other strategies. Okay, so again, the true parity trade. The long call is not a parity trade to the married put. The long call plus leaving capital on hold in your account is a true parity trade to the radioactive position. If you don't leave that capital on hold in your account, then you're no longer at parity. Once you start using more of this money to buy 5 calls of XYZ, 6 calls of stock ABC, 5 calls of stock 123, you've got more of this invested capital at risk in the portfolio. In the case of a downturn, you're going to lose more. You're going to have more at risk monetarily in your account than the 1% that I have allocated to the PXP position. Okay. So a quick summary. These are my thoughts on the comparison trades, also Ernie's as well, and also at the same time, we could say Kurt's as well. I do feel the RPM is superior to these comparison trades, but you're not asking the wrong questions. If you ever had these questions about this, these positions, these comparisons, looking at it going forward at the same time, I had the same thoughts. When I first started trading radioactively 6 years ago, I thought I was smarter than Kurt. I saw his techniques, and I said, you know what? I'm going to be able to get into better positions if I short the put and try to get the stock at a discount. And what happened? Well, 1 or 2 of my positions went down to where I was put the stock at a discount. The other 3 moved up, and I experienced severe losses. We saw that on the upside. Did I try to do the in-the-money long strangle approach? Absolutely, yes, I did. Same thing. I just noticed that in normal market conditions, I was not getting ahead. I would have been more profitable doing the married put position to begin with. And I had already had my experience with the long call buying and speculative long call buying as well. And Rick asked a good question as well. So with the out-of-the-money long call, you're not losing more money due to time decay and theta. In a sense, yes. If the stock does not move, they both have the same at risk, Rick. So that 230 we saw in the long call and the 233 that I had on the married put position, that's the time value on both options. So if the stock did not move from 35.08 and the implied volatility on the stock remained the same over the first 3 months, we'd see the exact same theta decay on both the married put position and on the out of the money long call. But at times, there is a skew, meaning that when the stock stagnates or it stays the same for an extended period of time, say more than 60 to 90 days, you're going to see more rapid decay on the out-of-the-money call than you will in the in-the-money put. It's strange, but the out-of-the-money options do see a rapid decay. Even though those two time values were about the same, we will see some theta decay more on the out-of-the-money option because it has less value. But you'd want to take a look at that too. When you're analyzing it, you could take a quick look at that as well. Okay. And you said, how sensitive are two trades and changes to volatility? I think the long money call would have more ways to get into trouble. Well, if volatility collapses, Rick, okay, and I'm in both positions, if volatility collapses and the stock hasn't moved, I'm going to lose time value on both options, okay, the in-the-money put and the out-of-the-money call. That time decay we paid 234. Let's say the implied volatility drops from 35 down to 28%. Okay, I'd probably see my 230 call drop down to about 160, but I'd also see a loss in the time value of my put option, even though it hasn't moved forward as well. Okay, so that's one of the things you want to be concerned with. Now, the advantage is if the implied volatility increases, we'll see a gain on both options. In fact, Kurt has had married puts where the stock hasn't moved. He's been able to close for a profit because something came out and the implied volatility spiked and his put almost doubled in price. Doesn't always happen, and it's harder to find positions that do that. But he did have that happen. He was able to liquidate the position with a reasonable gain, even before getting out of the position. Okay. All right. Now, very quickly, I know we're 6 minutes past the hour, but I want to navigate over to Power Options. I'm just going to quickly take the first trade. I'm not even going to do research analysis. We're going to use a straight example from the radioactive searches, and we're going to take the two questions that came in quickly from Sunil, and I apologize, Bill, as well. So now let's go over to PowerOp.com. And I'm going to go into the married put screen. Those of you that use Power Options know that one of the default searches we have, the first default search you see, is the radioactive trading positions, the same criteria that Kurt uses when first identifying a radioactive trade. I go from this list when I'm opening my new positions for the Fusion subscribers, as does Ernie. In fact, where's the one I was looking at? Ellie was one I had my eyes. EPAM I keep looking at and keep considering. But let's go ahead and take EPAM. Let's take EPAM Systems. Stocks is currently trading at 73.40. It's down today. A lot of things are. And we can look at the January 75 put. I'm sorry, the highlight is a terrible idea here. I keep forgetting it's not showing up as well as it did on the other screen. So here's the, actually no, I apologize, ladies and gentlemen. We're going to take HealthNet. And the reason why I'm taking HealthNet is because I want to be in this sort of 5.5 to 6% range. I didn't see that this was an 8% risk, and this is about an 8% risk. That's almost a 9% risk as well. Okay, so. And Hemang, I'll get to your question as well with everyone else. Let me get over to the profit and loss chart for this position, and then we'll take all three questions that came in from Sunil, Bill, and Hemang as well. All right. So HealthNet, 66.20. Kind of deep in the money, but that's okay. It's only 5.7% in the money, but looks good. January 70 strike put at 790. So my total investment would be 74.10. Guaranteed to get 70 back. So the max risk is $410 or $410. So again, if I had an account size of 40,000, I'd probably buy 100 shares in one put. But the maximum risk is right dead on percentage-wise of what we were looking at on our PXP example today, 5.5%. So let's go over to the profit and loss chart, see what we're looking at for this HNT potential married put trade. I'm not going to look at the stock chart and do my due diligence. On Thursday, I'm going to spend an hour with everyone showing how I use Power Options to identify a radioactive position, the research analysis I do, and then further discussion into management techniques a little bit, following the rules in the blueprint. So again, here's my position. 100 shares of HealthNet at 66.20, buying one January 70 put at 790. Total investment for 100 shares in one put, $7,410. Guaranteed $7,000 back to the risk of $410 or 5.5%. Is my static break-even 74.10? Absolutely. If I hold the position all the way to January expiration, about 6 months out in time, I choose to make no adjustments, I'd need the stock to be trading at 74.10. But I'm in control of two of those three factors. Can I control if the stock's going to move up or down? No, I can't. Neither can you if you're doing a spread position, a covered call, buying a long call, or any of those other strategies that we're currently trading. Okay, that's the one thing we can't control. What I can control is when I choose to get out of the position, and at the same time, looking at, I apologize, folks, looking at what income methods I'm going to do, sort of what Hemang said. So I'm in control of two of those three factors. Now again, why would I have opened this position? It's because that I have a sentiment that the stock might gain 5 to 8% in the next 30 days. Okay, so what if the stock moves up 5 to 8%? We're talking about $3.30 here, so we're going to be close to $69.50. All right, so let's plug that in. What happens in the next 30 to 20 days or so? Let's go right down to about August 5th, August 6th. Oops, I'm in September. So what would happen theoretically, based on the Black-Scholes pricing model, if the stock goes up to $69.50 by 8.6? Remember, 74.10 is our investment or our break-even point. Okay, so here we see that with the stock gain, we gained 330 on the stock. It says we're going to lose 356 on the put, but that's not accurate. We're not going to lose more on the put than we are on the stock. This is just using the bid price. I bet you the bid-ask spread on this, I'd get a better price. Let me just check something real quick anyway. Oh, geez, yeah. Look at the bid-ask here, 510 to 790. So that's what? $2.80, so $1.40. I could probably get into this position for around 670, 680 with the midpoint price. That would be my entry. It'd probably be closer to 660. But let's use 680. It's even lower, so 4.1% risk. And again, let's put in our 69.50. That bid-ask spread is way too wide on that position. All right. So someone remind me to use midpoints here for all of our comparisons. And I'm sorry, we're going to go to August 6th again. Let's go to August 7th. There, that's better. Okay, so the stock moves up to 5% that I'm expecting, and 30 days from now, we'd have a $330 gain on the stock, and we're probably only looking at a $250 to $240 loss on the put, so we'd have a gain of $83. We're still roughly 5 points below that break-even. Well, the break-even's changed now, it's 73, but we're still about 4 points below our break-even. But we're already at a profit. So remember, that break-even only occurs if we hold the position all the way to expiration. Now, Hemang's question is, do you write call after stock has moved up from your buy price? Well, I could do that. We're going to look at that in a minute. And okay, let me do this one first. Sorry. Hemang said, also, put is bought immediately after the stock. I buy them together. I enter the stock and the put together. And with what delta? I don't pay attention to delta, by the way. I mentioned delta when we talked about the comparisons because it's very important to see why that in the money long strangle will not perform as well as the married put. Okay, but the key is when we run that search we looked at earlier here, I can screen by delta, but I'm not. If you look for positions and you keep your risk within the rules of the blueprint, the full product describes radioactive trading, and you keep your risk in your range of what you want, be 3.5 to 7%. Well, here's the positions that match our criteria. Notice here that all of my deltas are within a very tight range of negative 0.48 to negative 0.6. I'm not screening by delta, but by using the other criteria to focus on limiting risk, if the delta was too high, it would be outside of my range. And if the delta was too low, the risk would be high. Technically, I'm already screening for implied volatility, delta, and even gamma without even using those. I have a webinar for you. You might want to check out there. Hemang, I don't know how much you focus on the Greeks here. But let's go to, I'm just going to sidetrack here, folks. I'm sorry. One thing here. This is a Power Options webinars. Okay, this is a public page. You don't need to have a trial or be logged on a subscription to access it. Let me just send that link to everyone. It's powerop.com/webinars.asp. And the options concepts view is Power Options Tools, Strategies, Options Concepts. There's a webinar here on Greeks and why you may not need them. Okay, and we're discussing some of those as well here as well. That's why we say you don't need those. John says, shouldn't you be using liquid options? I probably will, John, but we're not going to get into that right now. That's more of a discussion for Thursday. And we did have a limitation, by the way, John, on that search that was looking for options that had a minimum open interest on it as well. So this has the open interest and some volume I want. Market makers are setting a wide bid-ask spread. Okay, so when you have that wide bid-ask spread, I'm going to go ahead and make sure that I use the midpoint pricing to enter it. And in fact, a lot of my married put trades might only have an open interest of 5 or 10 contracts. And that's okay, because when I enter a 200, 300 trade, I always get filled at the midpoint with the risk that I want. Okay. And Rick says, along the same lines, John, he's not going to use an RPM with such wide spreads if he can help it. But of course, he's relegated to smaller stocks because of his capital, which yeah, when I first started, Rick, same thing. When I had my capital and I started trading RadioActive, I only had a few $1,000s to trade, so I was looking at lower price stocks as well, and they had a wider bid-ask spread. Okay, so now that we're looking at the profit and loss chart, before I jump into the comparisons here, remember when I'm using close to a midpoint, I'm a little bit above the midpoint here. Remember, we had that bid of, what was it, 510 to 6, let's use midpoints to be fair in all comparisons, okay? 510 to 790, $2.40 difference. I'm sorry, $2.80 difference here. So that'd be $1.40. So the midpoint here would be 650 or 660. It's really 650. So I'm going to use that for our midpoint when we get into the comparisons. But before I do that, let's go ahead and enter our position again. And I got to answer Sunil's question because he's been extraordinarily patient, as I've got to enter Bill's question. Way back, Sunil asked, if the RPM involves buying elite put at least 6 months at a time, why not also keep selling sufficiently out of the money nearer term puts against this anchor long put to reduce the RPM cost base? So I'm in the stock and I'm in the put. Hey, I'm bullish on the position. Let's go ahead and sell some naked put positions against this, some out of the money puts to lower our cost basis immediately. Okay, what's that going to look like? So we go to July, it's 10 days out. An out of the money put here, stock's at 66.20. Yeah, I'd probably have to use the 65 put. Okay, now remember first, with our 650 addition, our risk is now only 270 or 3.7%. So Sunil is asking, why don't I go ahead and sell the 65 put, let's call it even $1.40. All right, that's half of our maximum at risk with this bid-ask spread, 90 to 190. So why wouldn't I start selling out of the money? I can even go further, maybe get 50 cents for the 62.50. But why am I not selling a put right away if I'm so bullish? Well, it's because I'm not always right on the position. And what's going to happen when I enter this naked put? Remember, my total cost basis on the position initially was 66.20 plus the 650. So we had 7,270 invested in the position. Okay. Now I'm generating 140 in the position. So I'm going to lower my cost basis down to 71.30. But what do I have now? I have one long put, the 70 put. I sold an out of the money 65 put. So I've got that calendar spread here, but I've also got the investment on the stock position, which is here. So this is why we see this profit and loss portfolio. Why don't I like this? Because the put that I bought, my protective put in this case, even though I'm bullish on the stock, the put that I bought can only cover the stock or the obligation to buy shares of stock at the put strike price. So if the stock collapses, I'm losing on the original married put position and the full loss on either the naked put. I'll be forced to buy 100 shares of stock at a lower price. But my stock's now trading well below that. I've got an unrealized loss factored into the equation because I'm essentially at a ratio spread here where I've got two obligations for long stock that have infinite risk to the downside and only one put protecting half of it. And this is the same reason. Some of you are familiar with the blueprint, and you know the income method number 6. One of our popular income methods is doing a bear spread. A lot of you say, why don't you do a bull put spread? Because the bull put adds additional risk to the position, just like the naked put does. Now, sure, you have a limitation on the bull put, but even though I'm very bullish on a position, right now, what are we looking at for the next month and a half, my friends? We're in the heart of earnings season. I might like this trade. I might like the risk setup of this trade originally without the short put sold, but I don't want to take any kind of extra risk by forcing some kind of adjustment, which takes me away from the proper position sizing, forcing an ideal size trade, and keeping the single-digit risk. So now that is why I don't sell an out-of-the-money put against the married put as soon as I open it, no matter how confident I am that the stock's going to move up in price. Because as I showed, every time you try to go against that and you try to find a position, it's a different way to get into an RPM, you're using leverage or you're increasing the monetary risk, over time you're going to suffer losses with that. You plug that into the trade simulator we saw earlier, you're going to see significant losses where I might still be seeing significant gains on my married put positions, keeping the risk at only 5%. Okay, Bill says, is there a way that you can, oh sorry folks, let me erase all drawing. Is there a way using the RPM married put that you can finance the put with weekly options? Common question, and the other question was asked to, even if the stock hadn't moved, of course we were talking about would I sell a call right away? Remember, what my expectation is if I open this married put today. By the way, if on Thursday's presentation, if I see the same married put on our search and I'm comfortable with the stock, I'll probably open this one. I'm definitely going to open a Fusion trade on Thursday during the live webinar for our attendees or for the Fusion subscribers, but everyone can join us on Thursday, to see that. Now, here's our married put position. And Bill, when I open the position, what is my expectation? Remember I said my expectation is I think the stock has the potential. I would have opened this trade if I decided that of the 5 or 6 positions I saw, that this one was the one I felt had the best potential to move up 5 to 8% in the next 30 days. I'm looking at a target price around $69 or $69.50 somewhere in the next 20 to 30 days, okay? Let's keep that in mind. Now your question, can I finance this using weekly options? Sure, but you got to follow the rules in the blueprint, because if I just try to force income methods, let's just take the one again. Income method number 1, selling a call against the position. This HealthNet doesn't offer weeklies. We might take a look at another, but HealthNet doesn't offer weeklies here. So I'm going to go ahead and buy, I'm going to take the July 17th. There's nothing here really at the 70 call. Well, it's wide bid-ask spread against. It's maybe 55 cents. But let's look at the 67.50. Jeez, this is so weird. Let's call it a $2 bid-ask spread, 35 cents to $2. This is probably the one that has earnings coming up soon. That's why everything is so wide on the bid-ask spread, or in the pharmaceuticals range. Again, these are all things I would have researched and analyzed before opening the position. So let's just call this a $2 spread. So let's say we could get $1.40 for the position. Okay, so we got midway point, $1 less. We got $1.40 for selling the 67.5 call. And that's what? That's half of our at risk, isn't it? We get $1.40, our true risk is $2.70, so we're getting half of that. All right, and we're going to sell that call. Now, is this more along the lines of trading against myself? Sure, I took a shorter term trade, didn't I? I've only got 10 days to expiration, kind of along the weekly lines. I've earned a potential max return of 2.6%. if the stock happens to be trading right at 67.5 in the next 10 days. What happened here? We had a risk of only 270. How did I generate $1.40 but increase my risk up to 380? And that's because the direction to the upside. Okay, the risk is up here now, not down here. Your max risk here is going to be that 240 we originally had minus the 140, or 270 minus the 140. So you're looking at a risk of 130 at most to the downside if the stock collapses. But now you've more than tripled that risk that you lowered to the downside to the upside. So if the stock gaps up, and we're in earnings season, it jumps up to $75 or $78 per share, for example, from a good earnings, what have we done? The stock gained, but we get no more positive delta from the stock because we capped our gain with a short obligation. The put is declining rapidly in value at the same time, so we can't get above that. Now, in the latest free webinar that Kurt teach that is up on the RadioActive Trading in the free webinar section, he showed income method number 6, okay, and that's a bear call spread against the position. So, can I use a weekly bear call spread which leaves the upside open originally and not? Okay, so let's go to July and let's go to the 70 call, and again, 0 to $1.15. So let's say we could buy this for 60 cents or so. So now I'm only generating 80 cents of premium. I'm shorting a call and buying a call. It's a bear call spread, but in lieu of stock ownership, it leaves our upside infinite. Now again, by trying to force this income method right now and trying to sell it week by week by week and not following the rules in the blueprint, okay? And he followed up here. He says, but if you had a plan to sell a weekly option every week for, say, 2%, after 1 year, 52 weeks, you had 100%. Is this possible? Yeah, Bill, but you're not talking about a radioactive trade now. And what I mean by that is, remember, let me review one more time. I got into this position because my expectation over the next 3 to 4 months is actually the stock's probably going to be trading at 72 or 75. I'm expecting closer to a 10 or 12% gain on the position, doing my research and analysis. If I'm doing anything that involves selling a call or selling a short put, even on a weekly basis, we know the stock is going to fluctuate in price back and forth and back and forth. As the stock moves up, I miss upside for that weekly trade, so I've got to buy it back now, try to find a different call. As the stock moves down, sure, it's going to expire worthless, and now I might be tempted to sell a lower strike call, let's say if the stock's below 64, but then it bounces back up to 69. Now I've got to spend $3 to $4 to buy it back. It is too risky to try to force that long term. Are you generating 1 to 2% every time you sell a weekly call? Yes, but what are you doing to the rest of the position? Here again is even income method number 6. It's a riskless spread trade. We don't take any extra risk for this bear call because we don't have to fulfill the margin requirement because we own the stock. So we're taking advantage of the premium. We're leaving our upside open because the stock continues to move up. We're gaining more on the long call. We're losing on the put. The stock is capped, but we're gaining on the long call. So we still have infinite upside profit potential. But where's the problem? I generate 40 cents, 80 cents net credit. I lower my risk. That looks great. We dropped it down to 2.7% to the downside. I still have an infinite upside. But remember, my expectation is the stock's going to be trading somewhere in this range in the next 30 to 60 days. So I'm looking at zero gain or loss. So I'm going to be forced to manage this short call. I'm probably going to have to buy it back so I don't get assigned. So remember, is doing a weekly, trying to force a weekly strategy against the married put a good idea? Absolutely not if you're trading against yourself. And by the way, this is trading against myself. The original married put was not, but when I try to force the income method too soon, I did generate income. I'm happy that I lowered my risk. I left my upside open. But remember, we're thinking the stock's going to be around here. This is not the position I want to be in right now. Okay? I want to let the stock move before I plan to apply one of the income methods. I want to follow the rules in the blueprint so I don't handicap myself. I cannot tell you how many calls I get per month for investors say, hey, I joined you for your weekly presentation and I saw that Kurt was doing this, so I went out and I bought a stock at $60 and I bought the 67.5 strike put and I had a low risk of 6% and then I went ahead and sold the 62.5 call and the stock's now trading at 70. What do I do? You realize that that investor would have had close to a 6 to 7% gain just leaving the radioactive trading alone. Now they're looking at a loss of close to 10% because they took no further advantage of the upside movement. Bill, the blueprint discusses this. For each of the 12 income methods that are discussed in the blueprint, we talk about the do's and don'ts, when to use them, when not to use them. I do have investors that use weekly options. I use weekly options. Current married put I have right now is E-Trade. I trade an income method in the right context, following the rules. Usually been using income method number 1 or income method number 6. I haven't used a 4 yet, but I'm going to. But I've been doing that on 2-week out options. Ernie and I both feel that even in other strategies, credit spreads and so forth, that the 7-day out trades, you get less premium and they're more complicated to manage because you get the lower premium. We feel the sweet spot is that 2-week out time period. So I do 2-week out spreads in my portfolio on the broad-based indexes and ETFs, and on my married puts I do use weekly options if the conditions are met. Okay, with weekly options. You mentioned that you must buy the married put together with a stock. If you already own a stock, absolutely. This is a fantastic one. We've got a great tool, Juan, for you. It's called the insurance tool. Okay, so if you already have a stock that's up in price, or if you have a stock that's just stagnating around the same price, can you convert it into an RPM? Absolutely. Let's take HNT again. Remember, it's currently trading at 66.20. Here we go. Let me go back to married put and let me go to insurance. This is a fantastic tool. Let's say I actually bought HNT at $62 a month ago. I'll go HNT. I'm going to put in my $62 per share. And hey, I'm going to go to January. And, I'm not going to sell a call. So I'm just going to look at these here. Let's calculate this. So what's amazing about this is I have a current gain. You know, my cost basis of 62, I fabricated. I don't know if HNT was trading at 62 recently, but let's say I had a gain in the stock. So I currently have about a 7% gain in the stock. Now, I could buy that same, which put were we looking at there? Again, I forget. It was the 70 put, my apologies. So look what happens now. I take that same 70 put at 790, and I go ahead and buy this put now. So my cost basis would be 69.90. But I'm buying a 70 put. This means now, because I have the stock that has an unrealized gain by purchasing the same put we were looking at before, I now have a bulletproof position. I can't lose, right? We paid $7.90 for the put, so our total cost basis is $69.90. We're guaranteed to get 70 back no matter what happens. So that means even if the stock fell to $1 per share, we're going to make $10. And by the way, could we apply one of those income methods right now on a bulletproof position? Absolutely. I could go ahead and sell the 70 call for August or July. I wouldn't do income method number 1 if I know I have earnings coming up between now and the expiration, but you could do that. to increase the bulletproof status and realize further upside. But yes, Juan, even if you have a small loss on your stock or if you have a gain on your stock, now would be a perfect time to buy that put, use the insurance tool on Power Options to analyze which one has the risk reward that you want that best matches your needs. All right, so you can enter a married put that way, absolutely. You don't have to buy the stock and put together. You already own the stock. Look at your research, buy the put now. It's maybe 1 or 2 strikes in the money and far out in time, and probably lock in most of that gain as well, and you'll be able to still apply the income methods going forward. Okay, ladies and gentlemen. Well, I took an extra 30 minutes here of your time, but I thank you for staying with me. I want to remind everyone what to do next. All these things I'm talking about are all explained in the blueprint. If you haven't picked up the blueprint yet, go to radioactivetrading.com/iridium. You'll see the several bonuses are available there. If you pick up the blueprint or what we call the home study kit, which includes the 6 Mastery Series CDs that Kurt's put together. But if you pick up the blueprint, you're going to receive a free month of Power Options. You're going to be able to subscribe to the Fusion service at RadioActive Trading where you can follow Ernie and my trades and have access to the lessons as well. You'll get your first month of that for $10. The blueprint comes with a money-back guarantee. If you are not satisfied with a product within the first 30 days or so, just send it back to us and we'll refund your money. The link to go to see the special bonuses, there's a whole bunch of other bonuses we're running right now with the blueprint. Go to radioactivetrading.com/iridium. I'm sorry, radioactivetrading.com/iridium, not iridium.com. And you'll be able to see all of the bonuses that are currently available for the blueprint and the home study kit. Let me get that link right. There you go, folks. Remember, it comes with a 30-day money-back guarantee. You'll get 30 days free of Power Options, and you'll get that access to that first month of Fusion for only $10 as well. Well, you had mentioned, sorry, Rick says, is there any deals for current blueprint owners? Well, you've got access, of course, to any of the updates that we make at any time. Once you purchase the blueprint, you can download those. Kurt's on vacation this week. He's coming back next week. We're going to have some blueprint owner-only webinars coming up in end of July, beginning of August, and mid-August as well, most likely. And in addition to that, when we have other products that we do release, what's going to happen is blueprint owners will have maybe a special offer on that as well with new products that Kurt comes out if he enhances and when he does more of those Mastery Series CDs. My apologies there. But the only place where we'll describe to you, I showed you 1 or 2 today, but the only place where you can get full access to all of the information, the ins and outs, do's and don'ts, and the rules for setting up the radioactive trade and the various income methods can only be found in the blueprint. We won't teach those for free. That's the only place. You do have those free resources as well. Remember, radioactivetrading.com. You can go to the blog at radioactivetrading.com. You'll see several articles Kurt has written related, again, to some of these comparisons, a long call versus the married put. In addition to that, you'll also see some other comparisons of the different income methods, some examples of the income methods, bulletproofing, which is a fantastic place. We just saw that with that potential example on HNT, where now I have no fear of loss and I can do whatever I want going forward to generate income. And of course, we do host the webinars every Tuesday and Thursday at 12 noon. And I kind of mentioned that on Thursday right now, what I'm planning on doing is just showing Power Options for picking a new radioactive trade, research and analysis, and maybe evaluating income methods on some of my open radioactive trades as well. So we're going to showcase using the Power Options tools for radioactive traders on Thursday at 12 noon Eastern Time. All right, well, if you think of any questions later on, ladies and gentlemen, about the blueprint, about radioactive trading techniques, about the income methods, send me an email at any time to support@radioactivetrading.com. Remember, you can also call us during market hours. You can reach us at 877-992-7971. If you live outside the continental U.S., you can reach us at 302-992-7971. Myself or Ernie will be more than happy to answer any questions that you have. And in addition to that, of course, just remember, if you wanted to talk to Kurt, send us an email to support@radioactivetrading.com, and we'll have him give you a call, okay? Excuse me, folks. Rick just asked another question. Biggest trouble is evaluating different income methods and trying to decide, of course, without using Power Options, what to try. I understand, and if I'm not mistaken, Rick, I did send you that paper I wrote on the only blueprint owners have access to it on their account, but that income method cheat sheet there, and there's probably going to be an enhanced version of the income method cheat sheet coming out as well. I just got to spend some time to flush out each one of those and do 2 or 3 pages on it to make it more clear. But I'll make sure to get that to you, Rick, when that first comes out as well. And remember, anyone, if you want to see some of that information that I've done in the past, and I'm going to write a couple other ones too. You really want to start mention a couple things, but here, go back to radioactivetrading.com, and we talked about following the blog there. You're going to see some blog posts coming up in the near future. What I'm going to do later on this afternoon is I'm actually going to enter those parity trades I talked about. Not parity trades because they're not, but those comparison trades. We're going to take the HNT position I would have bought today using the midpoint for the put, and we're going to enter that calendar put using midpoint. And we are going to use that in the money long strangle using the midpoint. And we're going to enter an out of the money long call using the midpoint. And I'm going to track them in the Power Options portfolio. We're going to keep updates there as well. But I'll show you each of those positions individually on the blog. And of course, we're going to have some discussion, some other discussion on the blog coming up soon as well. All right. But if you wanted that other paper that we talked about, the comparisons of the in the money long strangle to the married put, just send me an email to support@radioactivetrading.com, and I'll try to get that to you as well. All right, well, ladies and gentlemen, thank you for staying with me. Sorry I went a little bit over there, but we did have a lot to cover. I wanted to make sure I got to everyone's questions that took the time. So Sunil, Bill, John, Rick, thank you all for sending in your questions. Thank you all for joining me today, ladies and gentlemen. Have a fantastic trading week, and we'll see you soon. Good night, everyone.